Welcome back to another episode of the Lone Star Capital podcast with Rob Beardsley, the CEO and founder of Lone Star Capital, and yours truly, Craig McGrouther, the Director of Business Development. And you might notice something different. And if you're a listener of this show, I thank you. But if you're just a listener, I really recommend you go into YouTube for this episode specifically. If I were to kind of tell you to go to YouTube for anything, I think this would be one of the episodes where I would recommend that because we're going to do a lot of screen sharing. And you'll also notice something a little bit interesting and different about Rob and I, which we are new acquirers. Our newest acquisition, it's not a beautiful 7-cap deal, well appointed in Dallas, unfortunately. Not that it exists, but we have some really sweet new shades. And why do we have these sweet new shades? We're athletes. We just came back from Sedona. We were playing hours upon hours of pickle on a daily basis. I play a ton of golf, well documented. And we found that there's a gap and a need in the marketplace that we didn't currently have, which is sports sunglasses. So now we are going to look really sporty. We're going to look, in vogue. I look like a Little League dad. And if you played on my Little League team with me in Alpine Little League in the heart of the Bay Area, the Mid-Peninsula, you'll notice that my dad probably also had a variation, as did your dad probably have something like this. But these are the sweet Maui Jim sport sunglasses here that will be sported for golf, pickleball, and everything in between, maybe a hike perhaps. Rob, can you share your sweet sunglasses as well?
Yeah, of course, I hopped on the bandwagon. So I've got my sporty Oakleys now. I'm good to
Yeah, I want to
go.
give everyone a side profile look. Yep, yeah. I'll just give everyone a look from the left, a look from the right. I mean, these are actually lovely. I can do a full turn here on my golf swing and keep my eye on the ball. It's not blocked like right here. So, yeah, we're
This is
moving up and up in the world.
not sponsored content.
Yeah, not sponsored, but, just saying. I think we look spiff and span now. That said, looking forward to a very jam-packed episode once more. Call to action. If you're typically a listener, you will likely get more value out of this show specifically via the audio, or so the YouTube version of this podcast. So please refer back to that. A couple items. We just had a great time at RaiseFest, and then we had an amazing friend trip to Sedona. Currently, we're at Best Ever right now. So if you are at Best Ever, come say hello or try to set a meeting with us if you're an investor or capital allocator, of course. We would love to meet with you there. And then following that, we'll be going to Houston. Big news in Houston, as a matter of fact. A big announcement coming soon, actually. Can't share too much on that yet, but just a little teaser and tickler there. We're absolutely thrilled for a groundbreaking accelerator announcement there, but can't share too much on that subject today. But let's just say it was the acquisition of the year, perhaps, for Lone Star. Of course, Rob's acquisition of the year was his lovely fiance in 24, as he had an incredible joke at his RaiseFest speech. But that said, RaiseFest was great. BEC now. We'll be in Houston the following week. If you're there, we'd love to meet with you. If you're a capital allocator or an investor. Additionally, some more call to actions. We are, in fact, going to do our flagship summit in New York City. We said we wouldn't, but we will. I talked Rob into it. It's really a lot of work on Dasha and myself, but we have to do it this year. This is the year of not, creating shareholder value. That's, of course, what you do every year, but this year of taking market share. And we want to do just, in fact, that. New York City, September 15th, pre-party on the 14th. Be there or lose out on the chance to meet your next partners and find your next investment. Also, we'll be doing a Bay Area event before that, which will be in April 25th to be exact. So super excited about that. We're going to do a West Coast style summit event. A lot of 1031 exchange topics. Rob will be giving an incredible keynote. We'll have some other great content and speakers lined up. If you are on the West Coast area and you're new to us, you want to kind of get more familiar with us, this will be a great way to interact with our investors, with our people. So super excited about that, and we look forward to hopefully seeing you there. If we don't see you before that, or we'll hope to see you in New York City. Did I miss anything else, Rob?
No? Well, we obviously have lots of things happening with different events. And like you said, BEC, Houston, Bay Area, Austin, New York. So just feel free to reach out to Craig to get plugged into what we've got going on, to learn more about us and get more involved.
You also, or not you also, but me, should have had this in the notes. We are hiring right now, Rob. What are we hiring for?
Yes, thank you so much for allowing me to spotlight this wonderful topic. So we are currently hiring for an asset manager position. It's the process is actually well underway. So if you're listening and you're interested, you're a little bit late, but jump in, go on to either Select Leaders or LinkedIn if those job postings are still open, or just email Craig directly and
Please do not. Who should they
yeah,
actually email?
bombard his inbox. Um, no, I think that's fine. Let someone be resourceful. If they want this opportunity, they'll find a way. Let them be resourceful.
Your
And so,
dad's FaceTiming me right now, by the
yeah,
way.
he just FaceTimed me as well. Oh, he's at the cigar place.
All right, why don't we take a quick pause from this?
Yeah.
Yeah.
Let's FaceTime him.
This is gonna get edited, but I want this to be in there, Kurt, our lovely editor. But we just had a interruption to the show because the best cigar store in the world that I've been touting for some time, Rob's father is there right now. Todd, good old Todd, who was on the podcast prior or before. And I was telling Rob this is the best cigar store. I went all through Switzerland. I went to multiple villages, multiple places, and not any of them came close to this spot. So that said, Rob, what boxes did we just get? And it's in Stade, if you're wondering, which is in Switzerland.
So, yeah, very cool. We were able to get the FaceTime and look at the cigars in the shop. And so we purchased Romeo and Julieta Millefleur, and then we also got the Partagas Millefleur. And so those are classic bestsellers, a little bit on the lighter side because I think generally speaking, you and I enjoy a little bit lighter cigars. We don't need to bomb ourselves out with nicotine
We're
and
not Francis.
crazy, crazy flavor bomb. And then we also got the Hoyo de Monterrey Epicuri series. I think Especiale is Epicuri or something like that. But those will be really good. That's a very popular Cuban cigar when it comes to mild profiles. So I'm super looking forward to that. And I don't know if you remember this, but years ago when I first came to Phoenix and I spent the summer there with you, I had a lender ship me, just kind of as like a gift, random gift, total surprise, ship me a box of Cuban cigars to Phoenix, and those were Hoyo de Monterreys. I can't remember which they were, but those were really great. Those are a really great smoke, if you recall.
Yeah, I don't recall smoking them, but I do remember you getting a package for them. That was like summer of 2020.
Correct.
A long time ago, but very cool. We just had to let you know what was going on there. So pardon the interruption, the ESPN show PTI, but we had to just let you know what was going on and why it's interrupted. So we'll obviously have to splice the first start because we stopped it to this now, but super cool there. Okay, so we were talking about hiring. I don't know if we got that all out there, so let's just go back into the hiring. What are we hiring for? Once more?
Yes. So we're currently looking to bring on one or two asset managers, actually. And I really like the idea of bringing on two asset managers at once because you're doing all this work. You might as well get more bang for your buck rather than having to do more duplicative exercises. Like if we want to then go and hire the second asset manager, let's say 3-6 months down the road, now you have to pay $2,000 to Select Leaders to do a premium job posting. And now you have to spend a whole bunch of your team's time sifting through resumes and culture index surveys and doing first round interviews and second round interviews. And so if it's much more streamlined, if you just do the same process and then you just end up hiring two people from the process, right? It's just much more efficient. And then of course, that's just the hiring process. Then you've got the onboarding process and the training process, which is going to be super involved and require a lot of time from myself and the team. And so you might as well take that time to do it with two people rather than one. So while we don't necessarily need to, I think it's a wise maneuver. I think it's great to have a little extra bandwidth and have more quality on the team, more firepower, because there's just so much going on and we're just doing so much. So I don't mind being, I don't want to go so far as to call it, I mean, it would be overstaffed a little bit, but at the rate we're growing, I think it's perfectly appropriate. And then in addition to the asset manager position, from a corporate perspective, because we're also doing a ton of hiring at the property level, but from a corporate perspective, we're also hiring for an accounting specialist position. This is a great position that is going to benefit the firm tremendously. It's going to free up Ina's time, and it's going to just really add robustness and essentially complete our accounting department, because we've built out the invoice processing systems and we've built out the utility process and the bill backs and things like that. And having an accountant really put all those things together and run it, and also do some internal auditing, which is always valuable, is going to be super exciting. So we've been working really hard on the accounting, and we've been switching up our financials and changing things, and it's been a bit of a bumpy ride, but we're finally getting to the end, it seems.
Excellent. And where do these people need to be sitting if they want to be hired? Because there's not remote positions being offered. Can they sit in Houston? Can they be in New York? Where will they be?
Both of these, the asset manager and the accounting specialist positions, are both going to be based in the New York office.
Awesome. So no remote positions. Once more, I am the exception to that. I love saying it too, that I am the exception to that. My life's better because of it. But that said, there you have it. Let's get into the show now. So without further ado, we're going to screen share. Big announcement here. Apple earmarks $500 billion for U.S. expansion. Company will create 20,000 jobs and build a factory in Houston to support its generative AI systems. Massive win. This is obviously construction jobs, people moving there to create the factories. And then you've got, of course, the new jobs that will come to the area. 20,000 new jobs. This is not Factory A shuts down and Factory B opens. This is net new jobs that are probably going to be high paying to the area. This is an awesome win for Houston. Obviously, Houston is our flagship market where we've got the bulk of our portfolio. So this is just amazing. Rob, did you want to kind of go into any of the nuances here, or kind of what this means economically, how long this takes to unwind, and kind of for it to be felt in the market?
No, I don't have any unique insight here. Like you kind of alluded there, it's going to take some time, obviously, to see the fruits of this, but Houston's always growing, and one of the best parts about Houston right now is that that growth is not being offset by dramatic oversupply, unlike Dallas, Austin, San Antonio, Phoenix, and other popular markets across the country. So this is not that this one piece of news is going to completely change the game from a growth perspective, but this just adds on to the thesis that coming out of this oversupplied era heading into 2026 and 2027, rent growth is projected to be very strong, because growth ostensibly like this will be there, and then there's going to be a dearth of supply because it's just been so difficult for multifamily developers to break ground on new deals, and it continues to be difficult. So we're really getting into a situation where supply shortages are going to be exacerbated, and like we haven't seen this since the post GFC era, like in 2010.
Yeah, well, we'll get into supply stuff, stop starts, because we've got a very meaty episode here coming up. But interestingly enough, Brad has kind of mentioned to me that Houston is starting to heat up a lot as a market due to the fact that the fundamentals are just drastically better in the Houston market with regard to just the general growth. You have stuff like this coming out. This is not the only company, but Apple is a household of household names. Fortune 10 company there, if you will, maybe even Fortune 5, with regard to just its size, how awesome it is there. So this is big, but Houston as a market, it's heating up because there's not been a ton of supply in relation to other markets in Texas. So good stuff there. On to the meat of the show as well. Moving next, I'm going to stop sharing this. We've got a lot of graphics to share. We're going to be poaching off our favorite content creator, James Ang. He just has so much good information, so many good takes here. But we'll start with the first thing on the graphics. So this graphic right here to start. Fourth quarter volume accelerates 64% year over year. 2024 transactions up 22%, which is kind of interesting. We did close Cortland Viscaya, now known as Viscaya Apartments then, but things have been pretty slow. If you see here, you've got a breakdown. Rob, can you see that clearly?
Yep.
Yeah, cool. So you see the breakdown of how transactions were done, color coordinated here. As I said, if you are listening on Apple or Spotify, I think YouTube would serve you better on this particular instance. But you see here, Q2 had some transactions, Q3 a little bit, but Q4 had some nice volume there. Any takeaways you saw or you have here from Rob?
Yeah, you can see that 2024 volumes in total are just slightly up, only 22% up from 2023. And these are both off dramatically off the peak of 2022 and 2021. But if you throw those 2 years away and you look at, and you honestly have to throw 2020 away because as you can see, looking at that 2020 bar, the second quarter was very slim because what happened around that time, obviously the shutdowns and COVID and everything kicked off. So second quarter, third quarter, very slow. Then people kind of woke up and started getting back to business in Q4 of 2020. So if you throw out those 3 years and look at 2019, 2018, kind of that's kind of the normal volume there. And so when you look at it from that perspective, 2024 volumes aren't actually that dramatically off what I would consider to be relatively normal. And if you go all the way back and you look at 2008, 2009, 2010.
God, that was worse.
Yeah, I mean, that's a depression. That's really insane. Also, values were much smaller back then. So it would be hard to have a chart that kind of perfectly adjusts for, inflation and just prices going up. But
It's really good
still,
take.
nevertheless, you can see that that's what it really looks like when things are very bleak and there's just depression. And so we're not quite there. And my prediction was that 2025 would bring more volume than 24. I think you actually predicted that 25 would bring less volume than 24. So I don't think we really have data on. I mean, it's just too early to have data on that yet. But it's been a very slow 25 thus far. But I still am holding out hope. I do think that 25 will end up being a higher transaction volume year than 2024.
Yeah, and if we just look back here, just real quick to kind of zoom out from a macro perspective, Q4 had the election. It had Treasury run up a ton, pricing in Trump winning and being more inflationary with tariffs, things of that nature, right? So it surprised me that Q4 had volume, but that's closes, right? Your Q4 closes are the deals that you lock up in Q3 when Treasuries were looking a lot more interesting. So I think Q1 of 25 is going to look heinous, very slow. Q2 might just be a little bit, probably better than Q1, I'd imagine. But Q3 and Q4 will be disproportionately, I would say, better than Q1 and Q2. But I just think it's going to be a little bit tighter there, if you will. And 26, I think, will be a bigger year for transactions. But we're going to go to a different slide. I'm not exactly positive on the order of this. I'm just going through how James's webinar and Q4 update was done with regard to showing. But we'll show you kind of the maturities coming up, which could obviously create an interesting setup there with regard to transaction volume happening. So on to the next slide. Q4 here, Q4 Dallas sales here. So it's a little bit blurry, but work with me here. So what this basically shows is the deals that were acquired in Dallas in Q4 and kind of more of the theme we've been talking about, which, it's kind of funny. If you listen to us, you're going to hear what's going on. Very little value add opportunities being done, order products. There's just not very much of a market for that. Those are also the deals that are probably most depressed right now. Therefore, these deals are at or below loan amounts. No one is rushing to lose money. However, you see Dallas there, right? As we talked about, the Class A, the newer product, has had a lot more of inventory being sold. So you look at the workforce housing there, very little deal flow being done there, very little unit count. And then if you look at the higher end stuff, it is selling a lot more. And then what you'll also look at, and I'm going to talk our book here, is Dallas over here, right? You look at, cap rates, going in cap rate for, core versus value add, and then the exit cap rate analysis. Well, guess what? We've been projecting a 5.5 exit cap rate on Grand Riviera. And then also, guess what? We bought this for a substantially better cap rate than the average going in value add deal, which just justifies deeper how good of a deal and a good of a buy that we actually made on that acquisition. Obviously, we'll see where things go, but on the numbers, from a value add perspective, this is pretty sweet to see. Can you see that okay, Rob? Or do
Yeah.
you need help?
Yeah, I
Okay.
mean, it is what it is. But yeah, these are always good, fun charts. Cap rates are so nebulous, so it's kind of in the eye of the beholder. And at the end of the day, you have to do your own cap rate analysis and be in the market enough to know relative value. But yeah, this makes sense. And this shows you that to the extent that this data is accurate, which the value add data is going to be the least accurate because there's the least transaction activity for the value add space. And there's, maybe just a group or two out there that are kind of skewing those numbers because they're buying value add, even though everyone else is not. But it's just showing you that why would you take the risk on value add when you're getting a pretty poor return premium for it. So anyway, we're a bit of a broken record on this topic, but yeah, it's the data is definitely there to support it.
Camden obviously is going through its, or just went through its earning calls as it's a REIT. And as we've been speaking on this, nothing new here really, but just to reinforce some concepts here. Multifamily deliveries reach a peak level not seen in over 40 years. So as mentioned, it will take a while for supply to kind of unwind here. But it is going to be very cool to see the absorption of those units happen, and obviously the lack thereof supply coming online, which of course, typically speaking, creates rent growth. So new supply pipeline, just kind of going back off that comment before, new supply begins to decline in Q4 2024. Pipeline to slow through 25, 26. So that just kind of shows you a rough showing of that just from a graph perspective. So more kind of evidence to support future rent growth and deals that are not going to be coming up. Development's going to be very low. So that value add or core strategy opportunities make a lot of sense. And I think one way we've been able to really kind of create really cool value that will be transferable to the next individual has just been our tax exemption route. So that's been something that's been really sweet for us. That's been something that we are looking forward to doing more deals like that, as well as other opportunities, whether it be buying a good core asset or buying, maybe an 80s or 90s deal that needs some love. Whatever it may be, we're open-minded to how we get our returns. But recently, we found the best value to be our tax exemption structures. Just, I would say in large part due to the changing of the interest rate environment, but also due to the fact that, rent growth is kind of a tough story to sell.
Also, just one comment to make on this. This is a national chart. So this is just covering the whole country. And the reality that supply is not just evenly distributed across every market in the country. And within those markets, it's not evenly distributed within those markets, right? So when we say that Austin has in 2024 40,000 units under construction or delivering or whatever the number was, that wasn't just evenly spread out across Austin. That was exacerbated in the highly attractive development areas like, I don't know Austin well, but downtown, I'm assuming, right, has a ton of supply and now has the most oversupply with the most concessions, 3 months free rent and stuff like that. So it's just, when you look at this chart, you see a dramatic trend. You see that supply peaked, and then what is that? Supply peaked in late 24, and now it's falling off a cliff because developers have been having a hard time all across the country to put new shovels in the ground when interest rates are super high and construction financing is not as attractive and valuations are down. So when they actually build the thing they want to build, it's worth less. So now there's less incentive. The numbers just don't pencil out. So although on a national level, you see this big dramatic trend, when you actually zoom in to the specific areas that really have this acute issue, this chart is even more dramatic. So that's something to keep in mind and understand what's happening, because truly, if you are looking at buying a deal in one of these oversupplied areas, submarkets, it's going to be a while. It's going to be much longer than what this chart implies as far as when you're going to get back to baseline, when things are going to normalize, stabilize, and you're going to see rent growth and things like that back into gear. So that's something that we keep very top of mind as we're looking at deals, right? We're looking at what's the supply pipeline of this given submarket, what's under construction and set to deliver in a 1 mile radius and a 3 mile radius, right? It's not enough to just say, oh, well, Houston just generally has less supply than Dallas. Okay, so Houston's a good market. Well, what about within Houston, the certain submarkets? And this is what makes buying today such a challenge, because if you're looking at, let's say, a good area in Dallas, you likely are battling a lot of supply issues, but it's still a good market. It's still fundamentally a deal you'd like to own, but you want to pay a price that reflects the near-term fundamentals. That for the next year and a half, you're probably going to see your NOI be pretty flat. And the problem is sellers don't see it that way, and sellers aren't going to market at prices that kind of reflect that reality. So what is a buyer left to do? Well, a buyer can either plug their nose and go for it anyway. They can look the other way, or they can just simply stay out of the market. And that's why there's just less activity going on, because buyers are just turning away from deals where the price isn't reflective of near-term fundamentals. So unfortunately, like there's this concept that you can buy a good deal in any market at any time, anywhere. And that is true, right? You can find, like, any asset's a good asset to own as long as you pay the right price for it. But the reality is not every asset or every market is offering you the, price that would potentially make sense at that risk level and those fundamentals. So it kind of forces you into markets like Houston, like you mentioned, that are just more transactable. Like buying in Phoenix right now is just not really realistic, because there's just nobody selling a deal at a realistic price that's actually reflecting of the fact that Phoenix has nasty supply still coming. Like, it's not over. Phoenix is not turning around yet. There's more supply. Austin is not turning around yet. San Antonio, same issue. So it kind of just forces you into markets that have better fundamentals, where you can actually, it's like basically when you're buying a deal, you're going to have to project 3% rent growth no matter where you're buying. So it's kind of up to you to pick a deal that's in a market where that projection is more realistic than not.
Right. And yeah, I mean, you have to project that, or you're just going to be pessimistic, and maybe you should just invest in hard money if you're not going to, think that, you're going to get a deal that's going to have a good return, mid-teen return, if you will, on projections that, has got zeroed out rent growth for the first 3 years, and the last 2 years got 3% after that. Your expense ratio is going to be totally out of whack there. That's why on our end, we like our tax exemption deals, where we, typically speaking, bring down rents a certain percent. And actually, Harris County wage increases have increased at about 3.2% historically, which is the amount we can kind of increase those rent control units. So obviously, that means that we've got to be at a point where rent growth is going on, and we've got a competitive advantage against other opportunities. But we like strategies over the last couple of years that have had that kind of downside protection in mind, where you're not fully predicated on rents increasing at X% to get a good return. Okay, another thing that we've been talking about, and this has been another theme, but just to go over it, long-term averages of the gap and spread between ownership of a home and rent. Okay, this number has never, ever, ever been larger. So, long-term historically, it's been $416. Right now, it's saying 1120 is the spread. That is absolutely crazy. In 2024, that number is incredibly wide. And, it looks like if you go back to only 4 years ago or so, it was well below that historical average, and those numbers have gotten crazy. Home prices, notably, have really, in most instances, in most locations, have not gone down. There's been some places with some pretty crazy insurance issues, and property taxes have gotten higher, where affordability is kind of tough there on the values and whatnot. But overall, you look at the spread there, and it's incredibly large. And this kind of goes back to the fact that Rob's been harping on this, that the American dream is different now than it has been before, or what you look at as your financial freedom kind of breakdown there. But that's a very, very big spread. I bought my house, as I've discussed on this show,
Many times.
Many times. But over
you
the theme
usually
here,
don't make it all about you, though.
no, I never do. It's never about me. But I bought my house, and obviously I could have saved a lot of money if I rented. but I did believe that, hey, the location I'm in my acumen, I can make a buck off it. But if I was really going on the numbers, and if I was a typical consumer where I couldn't roll my commission into it or couldn't do things of that nature, I would not, and I repeat, I would not have bought a house. But you look at these numbers here, and it's pretty crazy.
It's very crazy. But what's the crazy part? Is the crazy part that the gap is so big today, or is the crazy part that for such a long time, post GFC, right? Looking at this chart, at least kind of basically 2008 and then all the way to 2022, that it was so cheap to buy a house. I think that's the crazier part of this chart. It was incredibly cheap. And also another very interesting thing is how single family homes aren't that sensitive to interest rates, right? Because single family values really haven't come down much. And that's, I think, due in part because it's not purely an investment good. It's also it's a consumption good, and it's a necessity for families to an extent. And then also you have, I guess, people are getting wealthier. Maybe they can afford it. And so we're seeing more people, there's just a bigger wealth gap, right? And this is a reflection of that. And so actually really fascinating to think about how affordable it truly was to own a home for that 14-year period. And now I don't think that we're going to see a reversion to the mean. We're just going to see this continue. And that's my bearish sentiment. But if you look at, because this is a chart that only goes back to 2007, right? We need a chart that goes back to 1900 to really see what's up. And also we need to see what this chart looks like around the world, because the reality is, for whatever reason, in the US, it's way more affordable to own a home than in many other places, like in Moscow, like in Paris, like in big cities in Germany, and London for sure. So it's actually quite interesting how the income to home price is way bigger ratio in other cities around the world. So it's actually like a US phenomenon. And that's why the US has kind of led Europe in terms of home ownership. But I think that is kind of going away.
Yeah, and I think that when you've got interest rates sub 4% and your payments are very, very low, you're going to stay placed. So there's going to be a lot of ghost inventory. Even if you buy your next spot, I imagine a lot of people will keep their property because their basis is so great. They can make it an asset. They can make some revenue off it. Maybe they'll give it to their kids because they're looking around like, well, maybe this is their chance to own a home in the future. They can be close by. But if it's not, now the numbers are going to get so crazy, it doesn't make sense. So I think there's a lot of that going on. I think everything goes in cycles. The Bay Area used to be, obviously not cheap, but more affordable. Now the Bay Area is incredibly unaffordable. I look at Phoenix, where I live right now. It used to be cheap when I moved here. 5 years later, it is not cheap. It is not cheap to live here anymore. It's kind of crazy to think about. And I don't foresee a lot of people that grew up here used to it being dirt cheap are going to look around and, be able to live in the neighborhoods that they lived in, right? Just things go through cycles. So I think that's kind of an interesting fascination here that has gone on over time and will maybe not change historically now more than ever before. But you look kind of nationwide, inventory is down a lot on sales. 2024 was the worst year for real estate agents for commissions and stuff in quite some time.
Well, and let's not forget why we're even sharing this slide to begin with, right? Because
it's not very lead. Yeah, I agree.
We're talking very macro and kind of philosophical to an extent, but brass tacks, this is causing people to further delay homeownership. Or for many, unfortunately, homeownership is forever unattainable. And you just have a bigger swath of the US population that is going to rent for so there's going to be more renters and they're going to be renting for a longer period of time. So it's a double whammy for demand of multifamily. So this is kind of all you need to know. Yes, developers can build and in the short term oversupply the market, but in the long run, the US has a tremendous multifamily housing shortage, which underpins the entire multifamily investment thesis and why there's billions of dollars from around the world pouring in to invest in the types of assets, workforce housing assets, and Class A apartments that many of us in the multifamily business own and operate.
So another note here, Blackstone said 1 year ago that real estate values were bottoming. I think, Rob, you kind of called the bottom actually, in fact, in December of 23, roughly, if I'm not mistaken. But here, kind of some highlighted points here. New construction starts are dramatically down. Obviously, we just covered that, but just kind of go over that more and more. Um, overall, now I would just say this just kind of confirms that now would be a great time to likely start deploying capital if you have some liquidity into the marketplace. And also, if you want a long short kind of positions, the stock market's at an all-time high. You can sell at the high, and then you can buy, multifamily and real estate assets at the low, as it's obviously very debt sensitive. Funny enough, I was speaking to a good friend who's in venture capital that we're very connected with, and he was just mentioning that a lot of people that he's raising from, because he raised $170 million of a $250 million fund, of which a big selling point was, hey, stocks are at all-time high. I need to diversify and get out of here. And there, a lot of smart people, institutions, pension funds are getting into the alts like venture, like real estate, stuff like this. Blackstone, no exception.
Yeah, very impressive for Blackstone to have put out 25 billion in 2024, because 2024 was not an easy time to buy. And that's up 70% year over year for their volumes. So they basically did nothing in 2023, which that was a very stale year, a transitional year. But yeah, 24, we definitely saw some great buys, but gosh, we bought almost 200 million, but they bought 25 billion. That is a lot of money to put out. But overall, I think they'll do very well in those deals.
Certainly. And will we and our investors.
For sure.
Another note here, MAA, in 4 quarters, we prioritize achieving portfolio level occupancies that position us well for improving supply demand in 2025. The biggest thing here is just renewals. I think this is the big key here, is focusing on keeping the tenant in place as opposed to getting a new tenant for another rent premium and bump. So I just thought that was something of note there, that a lot of people are looking just to make sure the occupancy is at a good number, heads in beds, as they say, because there's obviously a lot of competition right now. Occupancy is certainly a problem.
Yeah, and basically having high rents to the detriment of your occupancy is really only valuable for a refi and for a sale. So if you're not really looking at a near-term capital event, it really behooves your operations to focus on renewals, to focus on occupancy, rather than trying to push rents every chance you can. Obviously, you don't want to be lagging the market and missing the boat, but understanding what the goal of the property is and understanding the true cost of turnover. Because when you actually look through a budget and you actually look at how sensitive, okay, well, if we actually have to have this tenant move out because we tried to charge a higher rent and they didn't want it, and now we have to turn the unit over and bring in a new tenant, we have to spend money on marketing and leasing costs to attract a new tenant. And then we have to spend money on turnover costs to make ready that unit, which can be thousands of dollars to do repairs and replacements inside the unit. And you're doing the whole thing all over again, which is why renewals are so valuable. Renewals, getting a renewal is like bumping rent, right? Because you got the person to stay and agree for another year, and you didn't really have to spend any money. And something that my mom Ina likes to do is she likes to do renewal incentives that actually add value to the property. So for example, to entice the existing tenant to renew their lease and stay for another year, maybe we'll offer to shampoo their carpets, or we'll look and see if, maybe we were planning on installing backsplash or replacing their stove or something like that. Well, it's like, well, why wait to do that before they move out? We could just do it now, and then that could convince them to stay. Yes, that costs money, so that renewal wasn't free, but that's a cost that we were probably going to incur anyway, and it adds value to the property basically. So yeah, renewals are really great. It's something that I really want us to become fantastic at renewals, because I think it's just such a pivotal key indicator that is a reflection of healthy performance. Because if a tenant renews, it's a big compliment to the office staff. It's a big compliment to the maintenance team, because the number one reason why tenants move out is due to maintenance issues. So if the maintenance team's crushing it, if the office team has good customer service, and we have a good product, then we should be able to get our renewals. And then kind of to connect our previous slide to this point, there's far fewer tenants leaving multifamily and entering single family homeownership, right? So I think MAA or one of these shops is talking about how they typically see 20% of their turnover come from tenants leaving and buying a home. And that's a very big number because they own luxury assets. They own renter by lifestyle type assets where people can actually afford the down payment and the payment for a home, but they're just choosing to rent because it's a lifestyle choice. So 20% is a big number, but right now they're seeing it cut in less than half, less than 10%, because it's not the case anymore, right? The gap from renting to homeownership is so big, they might be paying $2,000 a month for rent, but if they actually want to buy a house, now they have to actually pay $3,000 a month, and they're going to have to come up with, a $50K, $100K, or something like that as far as a down payment.
I think we discussed this in the last week's podcast, but once more, just to show you the audience here, just where places have a lot of negative rent growth, I believe is what this is referring to. And rent growth, yes, year-over-year rent changes. Austin and San Antonio are the worst. Dallas, not too far behind, believe it or not. Everyone loves Dallas, but I think we've kind of said this. We love Dallas too. Right now, is it a bit overrated? I think the answer is yes. Houston lies directly in the middle there, which is solid. And then if you go down, somehow Detroit is leading the way. You've got Kansas City, which is doing pretty well. Chicago doing pretty well. What I'm kind of seeing here is some of the gateway markets are actually doing pretty darn well right now, as opposed to some of the sunshine areas. But that makes sense.
Well, yeah. So this is interesting, right? Detroit, Kansas City, Chicago, Washington, D.C. These are places where very little supply was being built when everything was going crazy. So, yeah, now you see actually some really strong rent growth there, which is super interesting. But what I will say is I think if someone's looking at this chart and they think, oh, yeah, now's the time to buy in Detroit, probably not. It probably was actually a few years ago, if at all, if ever, because no one was betting on this rent growth and then it appeared. Now this is
Price
in the print,
market.
right? It's priced in, it's knowable, it's there, you're too late, right? So if anything, now's the time to be looking in Austin, San Antonio, because
Phoenix.
those places are being hurt, and then you're going to be able to catch it on the upswing to the extent you're comfortable and have the capabilities to catch a falling knife, because there's the realities of buying, which are very different than just thinking, oh, well, now's a good time. It's like, well, actually stare at the spreadsheet, look at the negative leverage, and really get comfortable with the thesis. And that's a lot harder to do. The highlighted city right in the middle, which has flat rent growth, is Houston, which is something that we've been harping on a ton. And there's the proof right there in the hard data. And rent growth is an encapsulation of not just demand and not just supply. It's everything. It's all together, and which is the most important thing, right? Like, I don't care how much supply is hitting the market. What I care is that supply overwhelming the demand, right? Because there's always been a lot of supply happening in Austin. People have been building like crazy in Dallas, but Dallas has just continually absorbed it and chugged along and just kept growing and growing. Only until now, where things have really slowed down, is where you're seeing the supply overwhelm the demand. So this is just the truest picture of what's happening. And yeah, it kind of also shows you the timeline of things. Like, because Houston is already flat, it's going to be the first to see the spike up in rent growth. And then Dallas will be next, and then ostensibly San Antonio and Austin. And then Phoenix is somewhere in there as well. So yeah, that's kind of, we don't time markets necessarily, but that's roughly the timing of things here.
I can imagine as well, where the farther you go down the spectrum of negative rent growth is probably the places we're going to see foreclosures happen. So, start to expect to see more foreclosures coming up in Dallas, Atlanta, Phoenix, San Antonio, probably Austin. I think there's going to be a lot of capital that's flowing to Austin because it's a sexy name, but expect foreclosures kind of going in there, which will obviously change the market. And as I said before and earlier, Houston is getting a lot more competitive recently, according to Brad, due to the fact that the fundamentals are very solid there. Now to my favorite graph, which is cap rates in relation to interest rates and the spread there. So if you look at the average cap rate, which is the gray line, and then the interest rate there, which is the kind of tealish blue, lighter blue line there. Very interesting. There's a little gap of positive leverage, but as you can see, over some time, has been bigger gaps of that there right now, but the market is quite competitive there. And you'll see the spread there. So basically, the spread going down means there's negative leverage, I believe. And then if it's going up on the line, it is positive leverage.
Yeah, the bar chart at the bottom shows the spread, and we went negative leverage in 2022 when rates spiked up. You can see the teal line spike up there in 2022, and cap rates are slower to react, and they've really only moved up a little bit relative to how much interest rates have moved up. So, yeah, we've been in basically negative leverage territory ever since. That's not a good thing. It makes it
No.
very difficult to buy. So
Yeah, and I just want to say, of course, capital is probably less available during, call that 2010 to call it 2019 or even 2020, one run there where you are on positive leverage and whatnot. Probably harder to raise. I'm sure 2020 and after was easier, 2019, 2018, but before then, but gosh, how easy it would have been to make money in real estate back in the day when you could buy just positive leverage like this.
yeah, yeah, it's tough. Well, we'll be keeping our eyes peeled.
Certainly, but of course we're going to be dollar cost average buyers. But just I think there's a fun really little graph here just to show you what's going on here, and we'll see. I mean, we're already seeing competition kind of come out there. A lot of institutions have been sitting on the sidelines, ready to place dollars in deals from a common position, from a preferred position. So I don't think these numbers are going to get any easier or any better here coming up. Perhaps I'm wrong. But it just kind of goes to show that it's a very competitive world now. There's more capital in the place ever before, which is definitely making the market more efficient than ever before.
Yeah, again, is the 2015 era where there was an abundance of positive leverage, is that the mean, and are we going to see a reversion to that, or was that an aberration, and neutral leverage or even negative leverage is more the norm? Furthermore, aside from cyclicality, there's also secular trends, right? And so over the last multiple decades, multifamily has gone from a no-name asset class that was just a mom and pop industry, a cottage industry, as Teddy likes when I say that, and now it's an institutional asset class. In the 80s, pension funds owned zero multifamily, and now multifamily is a substantial portion of a pension fund's holdings. So there's just so much more capital chasing the same amount of deals. And that's why you're seeing that spread compress substantially. So, and if you just think about it like logically, reasonably, if everyone is confident that multifamily is a great asset class and the tailwinds are super strong, you've got all this demand for housing, it's a stable asset class, it's performed super well. It even performed super well during a pandemic like in COVID. Meanwhile, hotels were a mess, retail was a mess. So multifamily just continues over and over again to prove itself as such a good asset class. And if everybody knows this, it's going to be priced accordingly. And if there's so many billions of dollars of capital chasing it, it's furthermore going to be baked into the price and reduce the spread. So if you just think about it logically, like why should you be able to buy a multifamily property at a unlevered yield higher than the interest rate that you can finance it? Because the equity side gets to get all the appreciation. The equity side gets to get the tax benefits. The debt side gets just a fixed rate of return, and they have to put up all the money. So it's like really the equity is too attractive. And so there really shouldn't be positive leverage on high quality real estate where there's high conviction in success.
Makes sense. Okay, and the final graphic here we're going to show you is just the maturities coming up here. So you'll see 2025 has got a ton of maturities here coming up. There's going to be deals that come up here, and I believe that is in the trillion or billion perspective there. I don't know, Rob, if you can see that, but nevertheless, you've got a lot of maturities coming up in 2025, which will likely be second half of this year, or deals that are happening right now where people are trying to figure it out. All of those deals, really, if they need to be extended, need cash infusions, cash in refis, capital calls, if you will, or pref infusions into the deals, which we're seeing, of course, going on all throughout the industry right now, from big name brands who are in the business So, I think it just goes to show a lot of these maturities coming up. 2027, the market should be more worked out then, but 25 and 26 is creating a lot of deals coming up to be here.
Yeah, for sure.
Cool. Well, there you have it. There's our breakdown. I think if you want to watch James's Q4 webinar, I invite you to do so. It's really awesome there. But Rob, do you have any final thoughts or takeaways after we just kind of went through all of that?
Yeah, sorry for plagiarizing you, James.
Yeah, very good. Well, thank you so much for listening to the show. We appreciate you listening. Big news coming up here shortly. Once more, if you know someone to be a good fit for our New York City flagship office there, for a job in the asset management world or the accounting world, I think you should be resourceful to find out where to apply.